We're excited to have everyone with us today. Again, this is your Office of Financial Regulation 2025 Annual Regulatory Highlights webinar. I am Toni White, Director of Outreach and Education, and I'll be your moderator for the day. So just a few housekeeping items before we get started. Your microphones will be muted during today's event, which will be recorded. We'll review it to make sure that it is eligible for posting on our Department of Labor YouTube page. Our administrative officer, Cynthia, is behind the scenes. So if you have any challenges with communications or seeing or listening, please enter the chat and let Cynthia know so that she can try to assist you today. And for your questions, thank you to all of those who were submitted in advance. If you have any questions, you can enter them in the Q&A questions pane. If time permits, at the end of this webinar, we'll be sure to provide you with the answers. If we do not get to your question today, rest assured we will respond to you directly after the presentation over the next couple of days. And lastly, we've added some important materials for your review in the handouts pane. This includes the speaker bios, copies of the slides, our foreclosure registration system fact sheet, as well as our annual report highlights document. So now let's move on to opening remarks from our Commissioner, Toni Salazar. Toni?
Great. Thank you, Toni. Appreciate it. Good afternoon. I guess we're there, right? 12:02, everyone. Thank you very much for joining us today for the Office of Financial Regulations 2025 Regulatory Highlights webinar. This is our 5th annual webinar, so I'm really thrilled that we have continued this for that anniversary. I want to thank all of you who are joining us today. In this session, OFR's senior team will share with you some of the important work our office has accomplished over the past year and the progress we've made so far in fiscal year 25, which is rapidly coming to a close. Our goal is to highlight information that we believe you need to know and to provide guidance to industry and to consumers on trends and some of the areas that are of interest to our office. Bear in mind, however, that our office has a broad mandate, so this session isn't going to cover all of the areas that are subject to our authority. Instead, it's designed to focus on highlights and trends. So before we go on, let me recognize the hard work not only of today's presenters and the supporting staff, but also of all of OFR's staff. Our licensing, supervision, and enforcement work, those are hard jobs, and the staff are all working diligently every day to make sure that Maryland consumers can transact their financial business safely and that the financial ecosystem here in Maryland is healthy and fair. We regularly produce annual and other reports, with our most recent annual report being issued at the start of this year. That report and the Student Loan Ombudsman are available on OFR's website. Just go to the About Us section. So as Commissioner, my team and I are deeply committed to ensuring that Maryland's regulatory environment is fair, transparent, and it supports both economic growth and public protection. Over the last fiscal year, we focused on modernizing our regulatory frameworks and improving the way we serve businesses and residents across the state. During the last year, we undertook several key initiatives that I'm especially proud of. Let me start with the most recent one that revolved around the launch of the first in the nation Maryland Community Investment Venture Fund, which is Part 2 of the Access to Banking Act. This is an initiative that is all about equipping our banks and credit unions with the tools they need to better serve Marylanders. It's about empowering entrepreneurs to launch and grow businesses that can fuel our local economies. So it's a bit of a stretch for our office, but with the help of the governor's innovation team, it's an innovation and initiative that I believe will have a great impact in our state. Our office also works closely with the legislature and the governor's office to ensure passage of legislation as it's needed. And this year, the Emergency Mortgage Trust Licensing Law was an important law that was passed to address potential disruptions to Maryland's financial markets. And we believe it'll set the stage for an examination of the state's licensing laws by the group of interested parties, advocates, and legislators who are going to be part of a committee to look at those issues. We've also just implemented our new assessment process, which represents a modernized office funding model that was approved by the legislature a couple of years ago. We also continue to support the ongoing changes that are being made to the NMLS and SES systems that make it easier for all the licensees to navigate regulatory and supervisory requirements. We're also obviously continuing to roll out new digital tools that give the public better access to information. So this year, our office also tackled some emerging issues like crypto kiosk licensing, earned wage access regulation, and digital security, areas where rapid changes required us to be proactive and adaptive. We continue to work with other state regulators to develop responses to the changes taking place at the federal regulatory agencies and in Congress. We're taking all of these actions to meet our mission of ensuring that Maryland's consumers are protected and that our state's financial services marketplace works well for all participants, particularly now as we face challenges of a fast-changing regulatory environment and economy. So looking at fiscal year 2025, we've kept up the momentum. We've introduced or will introduce regulatory reforms designed to provide strong consumer protections. We're continuing our outreach and education efforts, and we're closely working with communities and business to raise awareness of Maryland laws and encourage compliance before problems arise. I've always believed that collaboration is key, and we've partnered with other state agencies and industry groups to create a more coordinated and effective regulatory strategy. With regard to coordination and cooperation, I believe that it's important for Maryland to be involved nationally. And for that, I've been involved with the Conference of State Supervisors, and I recently started a one-year tenure as chair of the board of that organization. My service in that role highlights the importance of multi-state collaboration to Maryland and the entire state financial regulatory system. It's a position through which Maryland can make its voice heard on important national issues. And so overall, I'm excited that my team will have the opportunity to walk you through these and other highlights from the past year. They'll discuss items of importance to us and what's ahead. So we offer this webinar because we value transparency, your input, and partnership as we continue to refine and improve Maryland's regulatory and financial landscape. So thanks again for being here. Let's get started. I'll hand it off to Amy Hennon, who's going to do the first presentation. Thank you.
Thank you, Tony. I am Amy Hennon. I am the Assistant Commissioner for Policy and the State Student Loan Ombudsman. I'm pleased to offer this update on the policy activities of the office and also an update on the student loan activities. For legislative update, first I want to start with the virtual currency kiosk bill, Senate Bill 305. OFR worked with the sponsors to create the registration requirement for these companies. Regulations are in process. There are specific requirements in the bill that we'll provide guidance on. It requires registration of both the companies and individual locations. Our estimates indicate there are roughly 700 currently in the state. You may not have noticed them, but they're in gas stations, convenience stores, and other locations throughout the state, and they may initially look like ATMs. This bill is effective July 1st, 2025. The next bill is the Mortgage Trust Licensing Bill, House Bill 1516. A court case from 2024 required that passive trusts become licensed. OFR released regulations to facilitate that. After those were released, we heard some concerns from the marketplace that prompted this bill. A variety of industry and advocates weighed in. As Commissioner Salazar mentioned, the bill also created a licensing work group with industry and consumer advocates as members of that work group. Deputy Commissioner Hyland will talk a little bit more about this. That bill was effective immediately upon signing back in April. The Earned Wage Access Bill, House Bill 1294, requires licensing of these loan products, but generally exempts them from the requirements of the Small Dollar Consumer Loan Statute. Regulations and an advisory are in process. Deputy Commissioner Hyland will also address this issue, and that bill is effective October 1st, 2025. The three medical debt bills, House Bill 428, House Bill 1020, and House Bill 268, all impact the medical debt landscape. One of them prohibits liens on homes for medical debt, and that bill is more expansive than just hospital debt. Medical debt cannot be reported on credit reports any longer. And one of the bills creates a 3-year statute of limitations on hospital debt, regardless of whether that contract was signed under seal or other similar action that could extend the statute of limitations. All 3 of those bills are effective October 1st, 2025. We are aware of an issue with the Baltimore City District Court where judgments for debt are automatically enrolled as liens, and we're working on a resolution to that. The House Bill 796 and its cross-file Senate Bill 566, they increase the filing fee from $300 to $450. That bill is going to be effective October 1st, 2025. There's an assumption of mortgages after divorce bill, House Bill 1018 and its cross-file Senate Bill 689. The bill contains a requirement to permit a spouse to assume a mortgage that already existed for this requirement already existed for government-backed loans, but expands that requirement for non-government-backed loans, including jumbo loans. And this bill is going to be effective for non-government-backed loans where the divorce occurs after October 1st, 2025. Finally, for the legislative updates, House Bill 956 created an AI work group. OFR is going to monitor this work group as there could be impacts on the financial services industry and will provide any appropriate updates. That bill is effective July 1st, 2025. For our regulatory updates, the shared appreciation regulations became final this fiscal year back in December. They provide some guidance for these mortgage products after the passage of House Bill 1150 back in 2023. And those regs were effective 10 days after they were published. The branch licensing elimination regulations were final in February, and they provide some structure to how the industry assessment is going to function, and also clarified House Bill 686 from 2023. The mortgage trust licensing regulations were withdrawn in May 2025 after the enactment of House Bill 1516 that I mentioned previously. And finally, in April, we published a fee increase for mortgage loan originators. We received some feedback on that, which is under review. Any action on that regulation is currently paused. So first, I want to explain about the Student Loan Ombudsman's Office. The position was established by the Financial Consumer Protection Act of 2018. The Ombudsman position exists to provide student loan borrowers with a state-level office that can assist with complaints against student loan servicers. The Ombudsman provides information about student loan processes and works with borrowers and their loan servicers to correct mistakes and facilitate solutions. Additionally, the Ombudsman gathers information about the state of student loan servicing in Maryland to inform the public and the legislature. As Commissioner Salazar mentioned, the Ombudsman report is available on our website. For this year, there were considerable changes. For this fiscal year, there were considerable changes, both for previous borrowers and current students. Repayment options are in flux for previous borrowers. Many borrowers are currently in the Save Plan litigation pause on payments and interest. The Save Plan and potentially other repayment options may go away when the final results of this lawsuit are determined. Additionally, FAFSA for current students may present some challenges. Funding options that were previously available may not be available for the coming school year. There are a number of outstanding lawsuits that could create further impact for both borrowing and repayment. Additionally, there's a budget bill currently pending before the U.S. Congress that would have an impact on repayment options and the total number of loans or total dollar amount of loans that a student could take out. Generally, borrowers with servicing issues have seen slower processing times, response delays from the Federal Department of Education. Individuals can and should continue to submit their forms and complaints to Federal Student Aid, as well as to the Maryland Student Loan Ombudsman. Throughout this period, the Ombudsman has remained in regular contact with other ombudsmen throughout the U.S. to keep apprised of developments and share information and ideas. We have continued to engage with the Department of Education regarding policy and staffing changes, collection issues, and public service loan forgiveness challenges. Finally, the Public Service Loan Forgiveness Outreach Bill, House Bill 795, was enacted was signed into law in May of 2025. Employers, including the state of Maryland, must notify employees of the option to apply. The bill also required OFR to create documents on public service loan forgiveness Those materials were actually previously published as a result of House Bill 1172 from 2024 and House Bill 1048 from 2023, neither of which passed. And now I'm going to turn it over to Deputy Commissioner Michael Sprouts to discuss depository supervision.
Thank you, Amy. I appreciate that. Good afternoon, everyone. I appreciate this opportunity to share some depository updates from our office. In 2024, Maryland had 21 banks, 7 credit unions, and 4 depository trust companies that are state chartered. Our financial institutions have made positive strides, growing in assets, deposits, and loans while serving the communities with essential financial products and services. These positive trends are evidenced in these financial performance metrics. Bank assets grew 2% at $48.8 billion. Bank loans increased 1% at $35.4 billion. And bank deposits grew 4% at $40.8 billion. Our credit unions grew assets 2% at $8 billion. Credit union loans increased 7% to $6 billion, and credit union deposits increased 5% at $6.9 billion. And finally, our non-depository trust companies increased 19.3% to $417.2 billion in assets under management. The resilience of our financial institutions was reflected in positive financial performance at most of the institutions, even with challenges of lingering inflation, net interest margin compression, increased deposit competition, and commercial real estate risk, along with heightened concerns of cybersecurity and fraud. Senior management teams have managed balance sheets that allow institutions to be in the position to move forward with strategic initiatives that support their growth and the growth of local economies in our state. However, it's important to note that recent changes in federal fiscal and trade policy, along with global uncertainties, have started to form a new headwind that financial institutions will have to navigate. Senior management teams will evaluate how these changes will impact their consumer and commercial portfolios. Now, let's discuss some depository risk. In the regulatory ecosystem, many different types of risk can affect financial institutions. They often fall in the categories of financial risk, market risk, credit risk, operational risk, and compliance risk. For this discussion, I will focus on 2 risks that have an impact on Maryland financial institutions. The topics to be discussed are CRE with a focus on credit risk management practices and cybersecurity. Our first risk topic is CRE. According to the FDIC 2025 risk review, credit risk associated with CRE is still an elevated risk for banks. Although the CRE concentration is not as large, credit unions and non-depository trust companies also have CRE in their portfolios that can be affected by this risk. Therefore, this risk needs to be identified and managed appropriately through sound risk management policies and procedures. In 2024, the risk review described the current status of the CR risk as follows. Office CRE underperformed other properties types and is expected to continue to underperform in 2025. High interest rates continue to inhibit refinance capabilities of CRE loans as borrowing costs rose, while property-level cash flows weakened on rising operating costs, elevated vacancy rates, and slower rent growth. The volume of CRE loans scheduled to mature in 2025 remained high, and finally, CRE loan performance deteriorated. There are institutions in our state that have CRE concentrations. The deterioration of rent growth, elevated vacancy, increased expenses, including higher debt service due to higher interest rates, has caused stress in some borrowers' financial condition. Some commercial borrowers have already felt the pain from loans maturing and being refinanced at a higher rate, while others are scheduled to mature and refinance their loans from pre-2023 interest rates as low as 3% to a higher 2025 interest rates of 7 to 8.5%. In addition to cash flow issues, collateral values for some categories of CRE, especially office space, have deteriorated in value. Due to this risk, each institution must have a robust credit culture that has policies and procedures that can help management identify, measure, monitor, and control risk given changes in market conditions, interest rates, and geopolitical events. In OFR safety and soundness exams at some of our institutions, we have noticed weaknesses in proper risk rating awareness, along with timely collateral evaluation, charge-off and non-accrual recognition, and a lack of board awareness of problem loans. Therefore, it is prudent for the institution to have strategies to help manage this risk, such as a need for an adequate stress testing program for economic scenarios and the potential effects on borrowers most vulnerable to higher operation and borrowing costs. Have a robust internal and external credit review program to ensure loans are appropriately risk-weighted. Manage the commercial loan maturity and renewal process to evaluate if a borrower will have reduced financial capability and is less likely to qualify for a renewal under current market conditions. And produce current and timely commercial real estate appraisals. Our next risk is cybersecurity. As discussed in last year's annual webinar, cybersecurity remains a priority as cyber attacks against financial institutions and the vendors they use become more frequent and sophisticated. The risk of cybersecurity incident rises as dependence on networks and technology increases. A loss or compromise in confidentiality, integrity, or availability of systems may lead to fraud, as well as financial and reputational loss. Financial institutions must manage their information security programs and continuity of operation plans proactively and conduct ongoing due diligence of critical service providers. In OFR examinations, we have noticed that most institutions satisfactorily manage their cybersecurity program. Senior management understands the importance of mitigating cyber risk, but however, there has been minor IT findings in some exams due to the complexity and evolving landscape of this risk. Therefore, it is important to revisit some key strategies to mitigate this risk, such as having an effective cybersecurity risk management program to include preventive controls, incident response plan, and data recovery. Manage a cyber intelligence gathering, sharing, and analysis program which includes threat and vulnerability detection, strong authentication and access controls, including the use of multi-factor authentication. Consider supply chain risk management, known as SCRM, which is recommended by CISA to help with third-party technology risk. A review of cyber risk of third parties is a crucial step. Have a robust training program. Remember, 3/4 of breaches involve the human element. And finally, perform tabletop exercises. They are crucial to help understand what to do when faced with a cybersecurity event. The time to plan is before the event occurs. Now I would want to discuss some of OFR's strategic initiatives. And that first initiative is Security Scorecard. In regard to the cybersecurity concerns, OFR strategically deployed the use of Security Scorecard in December of 2024 to help our office promote the highest possible level of cybersecurity for the protection of Maryland's financial institutions and the consumers they serve. Security Scorecard is a cybersecurity tool that employs advanced scanning technology to provide continuous, non-intrusive monitoring of cybersecurity posture of many different types of organizations, including financial services. The platform supports regulatory oversight while encouraging institutions to strengthen their cyber defenses. The tool produces a rating system based on internet signals matched to the institution. The scoring is similar to a school-based system as it uses an A to F model. F-rated institutions are 13.8 times more likely to have a breach than A-rated institutions. The scoring is developed from 10 key factors such as application security, DNS health, network security, and patching cadence. OFR is using Security Scorecard as a tool. It will not replace traditional IT examinations. The report created will be used as follows: to support pre-planning for exams, monthly off-site monitoring, a strategic collaboration of sharing of the reports, was the reports are being pulled monthly and sent to the institutions along with a detailed issues report that explain what caused the score deductions. It allows the institutions to be able to research what is causing the issue and provide remedies to fix the issue. To date, this initiative has been a success. Our institutions welcome the opportunity for an extra level of reporting that can provide value and help support a positive cyber hygiene posture. Institutions have been engaged in the process, as many institutions have migrated to higher scores since the start of the initiative in December of 2024. Our institutions are currently in the A and B status, with 67% in A and 33% in B. Another important initiative that our office participated in was the development of an AI survey. OFR conducted an anonymous AI usage survey between February and March of 2025. The goal was to understand current and future AI adoption trends among Maryland state-chartered financial institutions. A few highlights from the survey are the institutions that took the survey were 68% banks and 32% credit unions. 57% use AI and 39% plan to adopt within 2 years. Common use cases: fraud detection, customer service with the use of chatbots. Primary benefits: operational efficiency and enhanced risk management. The risks and the concerns were data privacy, compliance, model bias, which is the black box concern. And interestingly enough, 30% are using AI for credit scoring models that can expand access to banking. And finally, 80% of our institutions currently using AI plan to expand AI capabilities. AI usage will continue to grow with our financial institutions. The ability to gather data and information with great agility and speed will enable our financial institutions to manage many different day-to-day functions efficiently. It will allow for the expansion of strategic initiatives that will help support the financial institution's growth, along with enhancing value of financial products and services in the local communities they serve. However, this technology would need to be monitored and regulated to ensure the technology works as designed without consumer harm. Now let's switch gears to an exciting update on the Access to Banking Act and the development of the Maryland Community Investment Venture Fund, known as MCIV. The first aspect of the Access to Banking Act is the assessment fee credits. In last year's discussion, the Access to Banking Act implemented the first phase of the act by providing 2023 assessment fee credits to incentivize Maryland chartered banks and credit unions to open and maintain existing branches in low to moderate income communities. The 2024 assessment fee credits were processed this year per the requirements of the Act. The breakdown of the fee credits were as follows. 11 banks and credit unions operating 31 branches in LMI census tracts representing $3 billion in total deposits participated in the assessment fee credit program. A cumulative $165,000 in assessment fee credits were awarded to 11 participating Maryland state-chartered institutions, with 4 of those institutions donating over $14,000 of their assessment fee credit to the MCIV fund, in which OFR will match to help further the mission of the fund. The second phase of the Act was to establish the Maryland Community Investment Venture Fund to help Maryland banks and credit unions partner with fintech and innovation to better reach underserved communities through the application of products and services that promote the financial empowerment and access to credit and wealth creation. OFR has been working to operationalize the fund with the first task of selecting an advisory board to help guide the strategic trajectory of the fund. In September of 2024, the advisory board was selected. The first meeting of the board was in October of 2024, which helped start discussions to formulate the main concepts of the fund. During that time frame, OFR entered into a strategic partnership with the Governor's Innovation Team to help develop a project management framework designed to implement the MCIV fund. Along with an additional advisory board meeting in February 2025 and the collaboration of the Governor's Innovation Team, the MCIV fund development has made great progress. Some of the progress points to date are that the Maryland Bank and Credit Union Innovation Roundtable events, where OFR and the Governor's Innovation Team had discussions with senior leadership from those institutions to find ways to serve small businesses and LMI communities by engaging fintechs, that they may address gaps in their ability to support these small business and communities. These discussions will be carried forward to help the continued development of the MCIV fund. In addition, a dynamic capital community symposium was held earlier this month that had representation from state-chartered financial institutions, community advocacy groups, state government, and fintech innovation, with remarks from Governor Moore, who participated in a productive group discussions that generated ideas and solutions to support greater access to capital for Maryland small businesses. Along with these key outreach events, additional progress has been made with the development of a website to invite fintechs that are interested in providing LMI products and services to our state-chartered financial institutions. The website, along with an email notification to potential interested fintech partners, has provided a list of potential candidates from the completion of an interest form. The interest form will be reviewed for LMI product and service relevance and feasibility. This is considered stage 1 of the fund process. To date, we have received over 80 interest forms. After screening the interest forms, promising fintech solutions will submit additional information for review before being presented to the advisory board. Final OFR approval will result in the fintechs being able to be on a list of possible candidates that can partner with Maryland state-chartered institutions to provide LMI products and services. This step is considered stage 2 of the fund process. When the state-chartered financial institution has selected a fintech for a short-term or long-term pilot, the financial institution and the fintech will submit a detailed contract and application that will explain the LMI product and service that will be offered by the financial institution. OFR will review and evaluate the contract and approve or deny the application and the use of funds from the MCIV fund. This is considered the final stage of the funding process. So now I would like to turn it over to my esteemed colleague, Kat Hyland, who is the Deputy Commissioner of Financial Services and Consumer Protection.
Thank you, Mike. Good afternoon. I'm Kat Hyland, Deputy Commissioner for Financial Services and Consumer Protection, and I'll be sharing a few key updates from the non-depository side of our work, focusing on industry guidance, modernization efforts, and enforcement priorities that reflect the evolving financial landscape. First, to start with key industry guidance. We've issued several important pieces of guidance over the past year, each designed to increase clarity, transparency, and regulatory alignment. First, the mortgage trust licensing guidance, issued in May of 25, reflects changes made by the recently enacted House Bill 1516 that Assistant Commissioner Hennon advised about. This guidance rolls back our prior interpretation and clarifies when mortgage investment vehicles known as passive trusts are exempt from licensing in Maryland. It also explains specific business exceptions and aims to ensure consistent regulatory treatment across the industry. Next, we released a non-depository assessment notice, which explains how our new assessment model works. This guidance clarifies how fees are calculated based on costs of supervision and licensee activity, not branch count, and highlights how this model supports more sustainable and equitable supervision. Assessment notices to companies went out on Friday, May 30th, and payment is expected by June 30th, 2025. Thank you to all who have already made payment. We also published guidance for pharmacy benefits managers in late 2024. As mainly in response to federal changes, we provided a detailed framework for licensure and compliance obligations in this growing sector. And lastly, we released updated foreclosure forms and instructions between September and October. These changes improve clarity and usability for servicers while better supporting consumers navigating the foreclosure process. Next, turning to modernization. Modernization remains a central focus of our work at OFR. We're investing in tools and strategies that make supervision smarter, more efficient, and more scalable. One of the most significant changes this year is the development and implementation of that assessment system that I just mentioned. And this is for non-depository licensees. By tying fees to activity levels, we're ensuring a fairer distribution of regulatory costs while keeping our system adaptable to industry changes. We've also modernized our mortgage examination process. This includes acceptance of qualified external exams and participation in multi-state reviews through CSBS. These efforts help reduce duplication while maintaining rigorous standards. A particularly exciting development is the advancement of the state examination system, or SES. In addition to streamlining exam management, SES has introduced badging for mortgage exams. Phase 1 of badging, which launched in March of 2024, identified exams that follow a core set of standards, which means mortgage companies will start seeing more consistency across state exams. With badged exams, companies can also expect fewer and more streamlined information requests. Phase 2 is currently in progress and focuses on improving internal examiner procedures. Now, while this work is less visible externally, it aims to reduce unnecessary steps behind the scenes, making the process more efficient for examiners and ultimately for licensees as well. The broader goal of SES badging is to create a more consistent, efficient, and cost-effective examination experience across states, reducing duplicated effort and saving time for both regulators and mortgage companies. We've also adopted a suite of technology tools to enhance our capabilities. Everlaw for enforcement-related document review and litigation support, chain analysis to help trace cryptocurrency activity in fraud investigations, and as you've already heard, security scorecard for monitoring the cybersecurity posture of our licensees. Next, we'll talk about enforcement activity. Enforcement remains a cornerstone of our work in ensuring a fair and accountable financial system. In January of 2025, Maryland participated in a landmark multi-state action involving Bayview Asset Management and its affiliates. This coordinated effort by 53 state agencies resulted in a $20 million penalty. This case involved serious deficiencies in cybersecurity and non-cooperation following a 2021 data breach that affected over 5.8 million consumers. Bayview has agreed to take corrective action, enhance their cybersecurity programs, undergo independent assessments, and provide 3 years of reporting to regulators. We also took action in several Maryland-based enforcement cases. Zip Inc., involving buy now, pay later services and consumer lending. Solo Funds, involving an online lending platform and unlicensed credit services, debt collection, and unregistered credit reporting. Benefits for unlicensed collection activity. Olympia Law Group for legal foreclosure, consulting services. And SCR Solutions for unlicensed collection activity, just to name a few. Please be sure to check out our website for additional enforcement matters from this past year. These actions reflect our continued commitment to consumer protection and a level playing field for licensed businesses. So now on to some enforcement priorities for fiscal year 2026. Looking ahead, our enforcement priorities reflect emerging risks, current trends in consumer harm, and new areas of statutory responsibility. First, earned wage access. With HB 1294 enacted, now we have clear authority to license and supervise EWA providers. Our focus will be on monitoring compliance with fee disclosures, license requirements, and consumer protections to ensure this product serves workers fairly. Second, mortgage servicing misconduct and foreclosure prevention. We're seeing rising complaints about misapplied payments, escrow issues, and aggressive loss mitigation. These issues often surface at moments of financial stress for borrowers and will be a top enforcement focus. Third, unlicensed and fraudulent financial services. From unlicensed online lending, debt collection, and credit services to unauthorized money transmission, we continue to see deceptive actors targeting Marylanders. Our enforcement efforts will remain aggressive in this space. So in closing, we appreciate your engagement and partnership as we work to modernize Maryland's non-depository regulatory framework. Whether you represent a bank, credit union, mortgage company, or other financial service provider, our shared goal is a fair, transparent, and resilient marketplace. Thank you, and I'll now turn it over to Assistant Commissioner Sharifa Balagoon for a closer look at the non-depository data and trends and money services activities.
Thank you, Commissioner Hyland, and good afternoon. I'm Sharifa Balagoon, Assistant Commissioner for Financial Services Licensing and Supervision. I am so happy to be with you again this year for our annual regulatory update. Today, I want to walk you through several trends we're seeing in examination and licensing reviews. I'll highlight some recurring compliance issues, offer clarification on misunderstood requirements, and provide guidance on how to get in and stay in compliance. Starting with mortgage examinations, and this is for our brokers. We are continuing to see issues with broker agreements and broker fee disclosures. We highlighted this issue last year, but the problem persists. Our law requires broker agreements to be signed and dated by both the broker and the consumer. Maryland law also requires that your broker agreements specifically disclose a broker fee as a specific dollar amount or a specific percentage. This requirement is to make sure that borrowers have knowledge about the fees and costs associated with their loan, who the fees are going to, and who's paying those fees. What we're seeing is broker agreements that have no signature from the consumer. We're seeing broker agreements where the broker fee is disclosed as a range, for example, between $1,500 or $3,000. Sometimes the broker fee provision is blank. This is not compliant. We need a specific dollar amount or percentage for the consumers. And this requirement applies whether the broker fee is being paid by the borrower directly or if the broker fee is paid by the lender on behalf of the consumer. It also applies whether the agreement is delivered by the broker or the lender. Regardless of who is delivering that broker agreement, the compliance obligations rest with the broker. It is important that the broker agreement specifically, again, informs the consumer how much that broker fee is. If not, your agreement is not compliant, it undermines transparency and informed consent. Moving on to a notice of intent to foreclose, specifically for owner-occupied properties. This can have its own webinar. Honestly, the conversation is specific to our servicers, our mortgage servicers. Maryland law requires that an NOI be sent to homeowners before you initiate a foreclosure in court. The NOI package must include a loss mitigation application, instructions to the borrower on how to complete that application. It must include a list of all eligible loss mitigation programs, including programs offered by the federal government, programs offered by Fannie Mae, Freddie Mac, any state loss mitigation programs, or any proprietary loss mitigation programs that you offer. The list must specifically describe the eligibility requirements. The NOI package also must include contact information for the borrower to call your loss mitigation department. What we're seeing is packages that have no eligibility requirements. Maybe there's an application, maybe there's a phone number. Sometimes there's instructions for the consumer to just call the servicer. Sometimes there's a statement that loss mitigation may be available. This does not satisfy Maryland law. If your NOI does not allow a consumer to understand their options outside of foreclosure and give them an opportunity to pursue those options, then your NOI is not compliant. Final loss mitigation affidavits, and again, this is specific to owner-occupied properties. Our law requires that the final loss mitigation affidavit documents the specific programs a homeowner was reviewed for and the specific reason the homeowner was denied or considered not eligible. What we're seeing are vague statements like not eligible, and this is not compliant with our law. The homeowner needs a specific reason as to why they were denied. So, for example, instead of just saying ineligible, you might change that to homeowner not eligible for loan modification because income is insufficient, DTI exceeds program threshold of 50%. That is clear and helps the consumer understand that one, they were considered for a loss mitigation program, what specific program that was, and the specific reasons why they were not eligible. It also helps us at OFR to understand that you followed the process. If your affidavit does not properly inform the consumer of the options they were considered for and why they were not eligible, if that consumer cannot walk away with a clear understanding, your affidavit is likely not compliant. Before we move on to the next section, I want to emphasize two key points One, with rights come responsibilities. Lenders have the rights to foreclose on property when homeowners default or fail to make payments. However, those rights come with responsibilities that must be met. Those responsibilities are clearly set forth in our laws and regulations, and they must be complied with completely. We're seeing a huge trend of non-compliance, and as Commissioner Cat mentioned in her presentation, we're taking these actions seriously and will be the subject of enforcement actions. Also, using a trustee does not remove your compliance obligations. We recognize that trustees sometimes complete foreclosure forms such as the NOI or the final loss mitigation affidavit. If you delegate your responsibility to trustees, it is still your responsibility to make sure that compliance is met, the compliance remains with you. Trustees must be treated like any other third-party service provider with ongoing QC and audit reviews to make sure that they are properly complying with applicable state law and regulation. MSB examinations. So it's for our money transmitters, and we're going to focus our conversation on the tangible net worth requirement. Under Maryland law, licensees are required to maintain a tangible net worth of at least $150,000 plus $10,000 for each additional licensed location or authorized delegate up to $500,000. This is a measure of a company's financial condition and strength. We continue to see non-compliance with this requirement. Earlier this year, Maryland entered into a multi-state consent order against Seagate Corporation, a money transmitter. Seagate failed to maintain its tangible net worth requirements in our state and other states, and it experienced deteriorating financial conditions. As a result, they were not able to fulfill customer money transmission obligations. As a result, Maryland and other states entered into a consent order, and pursuant to the terms of that consent order, Seagate surrendered its money transmission license in Maryland. It ceased doing business, and it was required to refund impacted consumers. This is not just a regulatory formality. It is important that you maintain your tangible net worth requirements because it helps ensure that consumers' funds are safeguarded. As your business grows, it is important that your financial capital and assets grow with it. Moving on to licensing and unlicensed activity, specifically with collection agencies. Now, we highlighted this last year as well, but we continue to see unlicensed activity in the collection space. Collection agencies are self-reporting and sometimes reporting unlicensed activity for up to 10 years. Some of the common reasons include a staff turnover or the third-party service provider dropped the ball. Neither excuse absolves liability. I want to take a moment right now to channel my mom growing up. Whenever she wanted us to remember something or pay attention, she would repeat herself 3 times and then ask, "What did I say?" So let's try it here. Unlicensed activity is a violation of Maryland law. Unlicensed activity is a violation of Maryland law. Unlicensed activity is a violation of Maryland law. And how many times did I say that? Exactly. We are looking at this issue seriously. Unlicensed activity carries consequences, including civil penalties. Last year, we reported that our licensing unit, we evaluated how we determine and assess civil penalties. We continue to build on our processes. And this year, we assessed a total of $227,000 in civil penalties, 110 of which was attributed to unlicensed debt collection activity. It is your responsibility to make sure you are properly licensed before you engage in any regulated activity in the state of Maryland. Credit service businesses, another slide that deserves its own presentation. This is for our credit service businesses. And if you are not sure whether you are credit service businesses, well, we are here to give you guidance today. There are many companies, particularly in the fintech and online lending space, who seem to be unsure whether our Credit Services Business Act apply to their business. They usually find out in the course of submitting a license application and a different license category related to their business model. Generally, if you are compensated for any of the following activities or services, our statute applies to your business: improving a consumer's credit record or history, obtaining an extension of credit for a consumer, or providing advice or assistance regarding either of the above. Some activities that trigger licensure requirements include matching consumers with lenders, offering software or an app that give consumers access to credit, referring or brokering loans, or operating an online lending marketplace. If you are assisting consumers to access credit and you are getting compensated, even indirectly, most likely our licensing law and our statute apply to you. Compensation includes direct payments from consumers, per lead or per loan payments from lenders, affiliate marketing revenue, or commission-based compensation from lenders. If you are helping consumers access credit, but you're unsure whether our statute applies to you, please reach out to our office. We are happy to speak with you, review your business model, and offer a license determination. It is always better for you to proactively seek clarity and receive a licensing determination from us than to find out through an investigation or enforcement action. And to close, here are a few takeaways. Feel free to print this slide out, paste it on your wall, save it as a screensaver, whatever you need to remember and take heed. If you have any questions, please don't hesitate to reach out to me directly or any of our directors of licensing and supervision, Arlene Williams, Christine Brooks, or Sabrina Brown. Thank you so much for joining us today. I hope these insights were helpful, not only as rules to follow, but as resources and tools for you to help promote and build trust, strengthen your operations, and better serve your consumers. With that, I'll turn it over to my colleague, Assistant Commissioner Meredith Merchant.
Thank you, Sharifa, and good afternoon, everyone. This past fiscal year, the Consumer Services Unit underwent structural and staffing changes and an overall rethinking of processes and priorities. One of the first priorities, and these are all ongoing and continuing into the next fiscal year. So one of the first priorities is to resolve outstanding escalated complaints, either by closure or referral for further investigation. These are more complex complaints, meaning they involve multiple regulatory issues and have cross-jurisdictional impact. And they typically involve new or emerging issues, novel financial products, or recently passed laws or regulations. So as such, these complaints require more staff time, in-depth analyses from our legal counsel, and consultation with management from OFR Supervision and Enforcement units before they can be resolved. Additionally, we've initiated a thorough review of our communications with consumers to ensure that we're using plain language, particularly with respect to OFR's jurisdiction and authority, and to ensure that we're being consistent and clear with what outcomes consumers should expect after they submit a complaint, including complaint referrals to our enforcement unit or to other regulatory agencies. We've been reviewing unit processes and procedures, especially as they relate to data collection and our electronic case management systems. CSU started using the state examination system several years ago for the non-bank, non-depository complaint case management and to communicate with licensed or registered companies. This year we initiated, and next year we intend to complete full transition to that system and away from our legacy system. A sizable component of this transition is updating our data points to align with SES's categories and the terminology used by the federal regulatory agencies. Modernizing our data collection practices will also allow us to better analyze our complaint info and to identify trends or patterns. The rapidly evolving landscape of financial services regulation means that the number and types of services and products we regulate is increasing.
and the complexity and urgency of the complaints has increased accordingly. So to that end, management is collaborating with our legal, policy, and supervision teams to bring more short form, subject matter focused trainings and searchable digital libraries and reference materials to our complaint investigation staff. So far this fiscal year, from July 2024 through May 2025, we've received 1,042 complaints. We're on track to receive roughly the same number of complaints as in the last few fiscal years, give or take. This next graph shows the number, or shows the subject or the product type of closed complaints as a share of the total number of complaints closed per fiscal year. This year, we closed a lower number of non-jurisdictional complaints. So these are complaints about federally chartered or non-Maryland chartered institutions, commercial loans or products, non-financial entities, or complaints from consumers outside of Maryland. We saw an increase in complaints under the consumer loan category. So this includes personal and installment loans, vehicle and sales financing, and other non-mortgage consumer credit products. So shifting topics, the foreclosure registration system includes copies of notices of intent to foreclose and the registrations of notices of foreclosure and foreclosed properties that are required by Maryland law. The notices of foreclosure are submitted after the court filing, and the foreclosed property registrations are submitted after the foreclosure sale. You heard about the notice of intent to foreclose, or NOI, in Assistant Commissioner Balagoon's presentation. Maryland law requires the secured party or servicer to send to OFR an electronic copy of the NOI document. This is done through the FRS, and the data that we obtain from the foreclosure registration system is used for outreach, supervision, and trend analysis. This graph shows the number of NOIs that have been submitted to OFR per calendar year. The number has increased year over year since 2021. When there was a foreclosure moratorium during the pandemic. The peak years were 2012 and 2013, during the height of the foreclosure crisis after the 2008 recession. This next graph compares the monthly totals for all three types of notices and registrations in the FRS. There are consistently more NOIs issued than there are notices of foreclosure filings or foreclosure sale registrations. So these totals indicate that most defaults do not lead to a court filing or foreclosure auction. And this map shows the concentration of NOIs by census tract for July 2024 through March 2025. The darker the blue, the higher the concentration. The pattern shows high concentrations in Prince George's and Charles County, as well as Baltimore City and the more densely populated areas of the Baltimore, DC metro areas, but notably, there's also hotspots in some of the more rural areas of the state too, like around Hagerstown, the Pennsylvania and Delaware borders, and in southern Maryland. If you're interested in downloading and analyzing this data yourself, see the foreclosure data tracker page on our website. That page has direct links to the open data portal pages, where we upload spreadsheets of data from the FRS. It's aggregated by Maryland County. And for the NOIs, we've included additional spreadsheets of data by zip code and census tract. And to close out our presentation, just a quick update on our outreach activities this fiscal year. We've prioritized expanding our outreach efforts for greater awareness of OFR among Maryland residents and to build trust with community partners. Thanks to Toni White's efforts, we've experienced an 88% increase in consumer engagement over the last fiscal year. We formed new partnerships, including with the state's financial empowerment centers and community action agencies, and our own Department of Labor's workforce division to ensure that we're reaching Maryland residents where they're at and making connections to better facilitate referrals between agencies and community groups. We're also updating our educational materials. We have a number of fact sheets currently in development. They should be finalized this summer. Please subscribe to our consumer advisory email list to stay up to date with the latest consumer news and outreach events, and you'll get an email notice when we've posted our new fact sheets or resources on our website. So with that, I will pass it back to Toni for our wrap up.
Awesome. Thank you so much to all of our guest speakers today for the valuable insights into all of the important work that we do here at OFR and the many tasks and challenges that we face ahead. We are currently at time. If you submitted a question in advance, rest assured that we'll reach out to you directly with the answer. Toni, do you have any final words for participants?
No, I want to thank the team for putting out some good information, and I want to thank everybody for joining us. And as you said, please reach out to us. We're always open to, discussions and trying to answer whatever questions you need to enable you to do business here in the state of Maryland.
That's right. Opportunities for collaboration are always here. Again, thank you to all of our subject matter experts and my favorite team. We appreciate the opportunity to present this information to you, and we look forward to speaking with you again. Have a wonderful day, everybody.